What a monetary reset really means. Why most people don't understand it. When people hear the words monetary reset, they imagine something dramatic. Banks shutting overnight, cash machines empty, markets collapsing, chaos in the streets. That image is powerful, and it spreads easily. It feels like something you'd see in a film. A sudden moment where everything breaks at once. But the truth is far more uncomfortable. A real monetary reset doesn't happen suddenly. It doesn't arrive with alarms or emergency broadcasts. It happens quietly, while most people are still going to work, still paying their bills, still planning holidays, still saving money for the future, still trusting the system to behave the way it always has. And by the time they realize what's happened, the reset is already over. The phrase, monetary reset, is everywhere right now. You hear it hinted at by politicians, usually wrapped in careful language. You hear it discussed by economists, but rarely explained in plain terms. You see it argued about on social media, often mixed with fear, anger, or disbelief. Yet almost no one explains it clearly. And that's not because you're not intelligent. It's because the system has no incentive to explain itself honestly. Most people can feel that something is wrong. Prices keep rising, even when official inflation numbers say things are improving. Savings don't stretch as far as they used to. Wages fall further behind assets every year. And the rules seem to change after you've already committed to the game. People feel this tension in their daily lives. They feel it at the supermarket. They feel it when renewing a mortgage. They feel it when looking at rent, energy bills, or insurance. They feel it when they realize they are working harder but standing still. But when they ask why, they are given vague answers. Inflation, supply chains, global uncertainty, geopolitics, temporary shocks. Those words describe symptoms. They do not explain the cause. They don't explain why the pressure feels constant. They don't explain why it never really goes away. And they don't explain why normal never seems to return. So today, I want to slow this conversation down. I want to explain what a monetary reset actually is, what it isn't, why it happens, how it unfolds, and why most people don't recognize it until it's already reshaped their financial reality. What people think a monetary reset is. Let's start with the biggest misunderstandings. The first myth is that a monetary reset means all money disappears overnight. That banks shut instantly, currencies collapse, accounts are wiped out, everything resets to zero. That kind of scenario is rare. It makes headlines because it's dramatic, but it is not how modern systems prefer to operate. The second myth is that a reset is a single switch pulled at a specific moment, as if someone flips a lever behind the scenes and the entire system changes overnight. Real monetary resets don't work like that. They are not events. They are processes. Processes that unfold over years, sometimes decades. The third myth is that resets only affect banks, governments, or the wealthy. In reality, monetary resets hit ordinary people the hardest, because ordinary people store their lives in wages, savings, pensions, and promises. And those are the first things that quietly lose value. This is the key idea most people never hear. Real monetary resets don't look dramatic. They look like policy. What a monetary reset actually is. At its core, a monetary reset happens for one simple reason. The debt can no longer be paid, not just by individuals, not just by companies, but by governments and entire financial systems. Debt grows over time. That alone is not the problem. The problem appears when debt grows faster than income, faster than productivity, and faster than real economic growth. At that point, the mathematics stops working. Eventually, every system reaches a moment where the promises it has made can no longer be honored honestly. When that happens, there are only a few options. You can default openly, you can restructure transparently, or you can reset quietly. Historically, governments choose the quiet option. A monetary reset is not about destroying money. It is about changing what money represents. That change can take many forms. Inflation held persistently higher than interest rates. Currency devaluation relative to real assets, changes to financial regulations, repricing of housing, stocks, and commodities, new financial tools layered on top of old ones. The system avoids admitting failure. Instead, it reframes the outcome. Your money still exists. Your bank account still shows a number. Your payslip still arrives. Your pension statement still looks intact. But what that number can actually buy slowly changes. That silent shift is the reset. Why systems choose quiet resets? Governments do not choose quiet resets by accident. They choose them because they are politically survivable. Open defaults cause panic. Honest restructuring creates outrage. Explicit loss forces accountability. Quiet resets do none of those things. They spread the cost over time. They dilute responsibility. They turn systemic failure into personal confusion. People don't revolt against inflation the way they revolt against confiscation. They don't protest slow erosion the way they protest sudden loss. Instead, they adapt. They work longer. They borrow more. They lower expectations. They blame themselves. From a systems perspective, that is success. Historical context. This pattern is not new. It has repeated throughout modern history. After major wars, when debts reached levels that could not be repaid honestly. After financial crises, when confidence had to be restored without admitting failure. After long periods of borrowing, when growth could no longer support the promises made. Every generation believes this time is different. It never is. The tools change, the language evolves, the technology improves, but the structure remains the same. Debt builds quietly. Growth slows gradually. Confidence weakens slowly. And instead of confronting the problem directly, the system adjusts the value of money itself. Not dramatically. Gradually. So gradually that people argue about whether it's even happening. But over time, the outcome becomes undeniable. Currencies buy less. Assets rise faster than wages. Savings fall behind. And inequality widens, not because of effort, but because of positioning. The reset completes itself without a single announcement. Why most people don't see it happening? One of the most important things to understand is why monetary resets are so hard to see in real time. They don't feel like crises. They feel like inconvenience. They feel like frustration, like confusion, like a sense that things are slightly unfair, but not unfair enough to name. People anchor their expectations to the past. They expect money to behave the way it always has. So when it doesn't, they assume something temporary is wrong. They wait for normal to return. But resets don't reverse. They replace. How this affects you. This is where the conversation becomes personal. Because monetary resets do not punish recklessness first. They punish responsibility. They punish savers. They punish patience. They punish those who delayed gratification. They punish people who trusted long-term promises. If you work hard, save consistently, and plan carefully, but still feel like you are falling behind, that is not a personal failure. That is the system shifting pressure away from itself and onto you. Quietly, legally, gradually. Most people do exactly what they were told to do. They study, they work, they save, they avoid excess. And yet they feel like the finish line keeps moving. That is not accidental. That is how resets function without open conflict. The psychological side of a reset. Resets are not only financial, they are psychological. They change how people think about time. They shorten planning horizons. They encourage consumption over saving. They reward speculation over patience. When money no longer holds value reliably, behavior changes. People take more risk. They chase returns. They feel forced to do something just to stand still. That instability is not a flaw of the reset. It is part of it. What to watch for. Monetary resets do not announce themselves. They introduce themselves politely. You will notice new language entering public conversation. Words like stability, resilience, modernization, inclusion, protection. You will see new systems presented as solutions. More oversight framed as safety, less access framed as convenience. Reduced choice framed as efficiency. You will be told it is necessary, that it is temporary, that it is for your own good, and it will not feel dramatic. It will feel administrative. That is how you know it is real. What a reset is not. A monetary reset is not the end of the world. It is not a single collapse. It is not universal ruin. It is a rebalancing of who carries the cost. Some people adapt early. Some people are positioned well. Some people benefit. Others pay without ever being told they are paying. Understanding this does not require panic. It requires clarity. Understanding a monetary reset does not make you paranoid. It makes you prepared. Because once you understand how the system actually works, You stop blaming yourself for outcomes you do not control, and you start thinking differently about money, risk, and time. If you want calm, clear explanations of finance without hype, without fear, and without denial, you are in the right place. Stay awake. Stay aware. This is Felix. See you next time.